Hi everyone and welcome to our reporting season insight session. I'm joined here today with our Chief Research Consultant Mathan, and we'll be going through some of the current macro conditions in the market, some things that are coming up this reporting season, and giving you some good updates as we go along the way. Mathan, great to have you here.
Good to be here.
Let's start big picture. What's the current macroeconomic situation telling you right now, Mathan? Interest rates, inflation, China situation. What is going on here and how does this tie into the commodity cycle right now?
Yeah, look, it's a $64 million question. I guess the biggest thematic is the bond market and the bond yield cycle. So we've had a 40-year decline in bond yields, and that's got to zero during the pandemic. Basically, it can't get any lower. That's your cost of borrowing. What we know for a fact is the next decade, the cost of borrowing is going to be higher than the last decade. That hasn't happened in 50 years. So the global economy doesn't really know what to do in this cycle, and so is most of the fund managers out there. So we're dealing with that problem. Hence, we have trade wars. Hence, we have asset bubbles. We have all-time high asset prices. We have historical low unemployment in most regions. And yet we are expecting rate cuts, which just doesn't make sense, but here we are.
And you would have noticed that the RBA just cut rates again a couple of days ago. And I guess, look, in terms of investor sentiment, Mathan, are you seeing a clear preference between defensive and growth stocks at the moment?
Yeah, so we've had probably one of the bullish cycle for growth stocks. And that comes down with how markets have assumed that cheap money will drive growth. And you've seen a fair amount of, I guess, risk off being pressured down. So in that context, growth stocks have dramatically outperformed to the point where markets are looking for large caps to all perform dramatically well. Now, Commonwealth Bank today is a classic example. We've had a result where the bank barely grows. It's paying yield less than what you get in the bonds, and yet it was trading at 20-year high multiple. There was only going to be one outcome, and we're seeing that. There's a pullback. You don't need to be a bank analyst to know it's expensive, but it's just a size game. So the momentum of passive money has pushed up all the large caps. So people will tell you, like US mega techs, they're driving all the markets higher, and that's because of AI and so forth. But the irony of it is, you can look at the DAX in Germany, which has no techs. They're classic old school manufacturing. DAX has outperformed the NASDAQ from the lows of 2022. So the reality is it's really about the flow of money, and that has pushed up valuation around the world. So for investors to look at the market and see growth stocks outperforming, that's logical. Have they run ahead of valuations? Well, NASDAQ is trading at 20-year high multiple, so that tells you so. So you have to be careful on where you are.
Exactly. And Mathan, on that topic there, which sectors do you think could surprise on, say, the upside or underperform moving forward in this type of market?
Yeah, look, naturally, we are trying to solve a debt problem with more debt, which has never worked, but hell, we'll try it anyway. And the problem here is it kind of flows down. When governments takes on too much debt, then that drives inflation, which means, you and I, consumers, will have to use more debt to buy the same thing we were buying before. So hence we have inflation. And so in that scenario, the debt becomes the biggest problem. And we are basically, everyone is taking on more debt. So the consumers are the biggest risk here. We can, sugarcoat policies and the effects of it. We can even make up stories that, tariff is not a tax and all that. But the reality is the consumers, you earn X amount of money and you spend that money. You're getting less for what you are spending. So naturally there will be an effect. So I think the biggest worry is consumer spending, and that flows on to asset prices. So anything that's linked to asset prices, so you've got banks, you've got fund managers, you've got property stocks, they will be under risk. Anything related to consumer spending, so retail, consumer services related industries, those are the ones that carry the highest risk.
Brilliant. Good. Thank you for that insight. And look, one key topic that is on everyone's minds, you would have seen of course, how gold has been performing in the recent past. It's been getting a lot of attention lately. Could you explain why we're bullish on gold at the moment to investors watching?
Yeah, look, we've been long gold since probably 2019, and we haven't taken profit at all. We think there's more to the upside. I'm not there to pick a spot gold target. That's that's what you might as well throw a dart. I just know that it's going higher. The reality is gold moves with inflation adjusted bond yield. So the bond market, as I said, it's going through a dramatic change. It's a 50-year cycle, and as bond yields rise and inflation rises, then you've got inflation adjusted. The bond yield is going higher and higher. So it gets squeezed in real terms, and when that happens, gold runs higher because you're trying to get somewhere where it's going to protect your money. So you don't want to get inflated out, so gold becomes the hedge. It also becomes a hedge for market risk. So you got 20-year high market, historical asset prices, you got economic problems, we've got trade wars going because they're trying to distract from the economic problems, and then you've got inflation problem, right? Which is generally what happens, all of them happen together. And in that cycle, gold tends to be the hedge that protects you. And was our thematic, still is our thematic, almost inevitable at some point in the second half of this year, we see inflation run up again, and that will be positive for gold.
Good. So I guess that really backs how we are quite bullish on gold regardless of these high prices. And for those watching, what gold companies should we keep an eye on?
Yeah, I'm a big believer in when you have a commodity cycle and you're in the middle of it, you go to the operations that are producing the commodity because they literally lock in the price and they're churning out cash. So the sector that is literally swimming in cash at the moment is the Australian gold miners. So I'm a big believer in that, and the other advantage you have is any kind of global growth risk tends to be negative on Aussie dollar. So for Aussie gold price at the moment it's around 5,200. Even if gold doesn't move, if Aussie dollar goes down, you get better margins. So, all the big producers are absolutely killing it. Today we had Evolution report as a very good result. Northern Star had an operational weakness, but that's, it happens with miners, and all miners are having cost blowout. That's just, that's inflation. But Northern Star is another one that offers great value, massive player. Pantara's doing well, Regis is doing well. There's a lot of stocks in the Aussie gold miners that are producing, doing really well.
Good. So ones like Pantoro that we covered, maybe even some in the more beginning space like Black Cat. We've been looking at a few others. There's a lot of activity going on in the gold space. And yeah, we are remaining bullish, and those are a few to really keep your eye on if you're watching. But look, I wanted to shift to the big end of the tower.
Sure.
So these are your bigger miners. So we're talking about BHP, Fortescue, Rio. How do their current valuations stack up against historical averages?
The big miners are actually not that badly priced. They're not expensive, but remember, commodities are cyclical. So classic cyclical, and people forget, yes, I know that central banks try and avoid economic cycle, which is kind of like the third mantra that nobody wants to talk about, but commodities go through cycles. So the biggest, I guess for me, there is always supply side shocks. That's positive, but it's not a driver of the thematic. It's really about the demand side. So the demand side for commodities, and the biggest commodity is iron ore. Australia literally runs its budget on iron ore price. And for most of the main miners, I mean, FMG, that is the only one, but for the others, it's still the most dominant play by far. Iron ore, I think, holds up, but I don't think it's going to do great. Because at the end of the day, the biggest customer is China, and their cycle on the property cycle, there isn't an indicator that that's improving. It's kind of stabilized, and during the trade war, China continues to stimulate their consumer spending rather than the asset bubble. Unlike every other Western economy, China is the complete opposite. They are going consumer spending, not asset bubble, where everyone else, even though they didn't care about asset bubbles before, now they have asset bubbles. So for me, commodities will take time, but because of the low prices, supply will come offline. We've seen that in coal, we've seen that in lithium, and we will see that come off. And we can see that in oil as well, because shale is starting to struggle in the US. If you look at the rig count in the US, that's falling quite a bit because low oil prices started to curb a lot of them. And so in that context, there will be supply side shocks, But I think in the short term, I think commodities will mostly remain kind of like in a consolidation phase. And so I wouldn't get excited yet, but there are specific commodities outperforming the market. That's what we're interested in, whether it's rare earth, whether it's uranium, whether it is oil, whether it is coal. There are specific areas that are doing really well.
Brilliant. And you mentioned a really good key point there, and that's to do with China's demand. It's always a key driver, especially when you look at iron ore prices. What's your outlook coming into this reporting season, and what are you expecting for the next couple of years ahead?
Yeah, look, I think with the resource stocks, you've got a bit of protection because they do quarterlies and they give you a heads up on where their numbers are on production and costs and so forth. So it's very hard to get massive shocks. If you do get massive shocks, you should be worried about management there. But generally, resource stocks are kind of protected. But I think China is going to be very consumer driven. So we've actually looked at the Chinese techs for the last couple of years. They've outperformed quite dramatically. They've actually outperformed NASDAQ. And I remember a couple of years ago, major investment banks said China is uninvestable. Yeah, that's always a sign that you should be buying. And Chinese techs, you can look at ETFs to get exposure into that, and they've done really well. So as China targets their stimulus towards consumer spending, that generally goes through the Chinese techs, and they benefit from it. So I expect the Chinese techs to continue to do well, especially with trade wars extending. I don't know when they're going to finish, and that's just more and more stimulus going into consumer spending.
Exactly right. And one funny thing is to put out there, as you mentioned, with China's market being said to be uninvestable years back, Warren Buffett picking up a huge stake in BYD back in 2008. You got to follow the smart money.
Yes.
And up until now, you've seen that pay off.
No, look, I still remember that interview. Charlie Munger, I watched it, and the late Charlie Munger actually said BYD, and I was listening going, I was like, what is BYD? I had to actually Google it to find out what it was. And you realize how phenomenally effective they have been, and their strategy has been so good for so long. They've just, they're not just beating Tesla, they've just gone past it.
Exactly, completely. And I guess the biggest elephant in the room, what most investors probably want to know, of the three major miners, just going back to the big miners out there, what do you think offers the best risk to reward right now coming into reporting season? So we're going into Rio, BHP, Fortescue as the big three.
I don't think you're going to get a lot of shock, but I think the outlook, you're always going to prefer someone like a BHP because it's more diversified. And I think they have historically been able to divest out of bad BHP, which became South 32.
Yes.
So they do have a history of doing a much better asset allocation for me. So I don't think there's a huge difference between BHP and Rio, but I suspect BHP tends to get the better multiple. So there will be probably a better one. I don't see a huge risk in the reporting season for them. They're relatively well flagged. FMG for me still heavily reliant on one commodity, which I don't see a huge upside in the short to medium term. So I don't see the catalyst for it. So I'd probably lean towards BHP or Rio.
Yeah, and it's quite fascinating what they're doing with their newly acquired copper assets too.
Yes.
Seems that they've stepped away from iron ore, but still keeping it as a main trade.
Yeah, it's interesting the way they went about it. They didn't say that we're walking away from iron ore, but they're increasing their copper, like with Oz Mineral takeover by BHP and so forth. I mean, that's probably the best copper asset in our market, and that disappeared in BHP. So what they've done is by default, they've increased the copper exposure of their portfolio. So yeah, I think that, those kind of moves, don't listen to what they say, look at what they're doing. And they have expanded copper exposure. Copper, you need it for everything from building a house to EV to technology to data centers to AI. So copper is always going to be there. So the fact that they are leveraging into that more tells you where the outlook is. So I think you should be less targeting iron ore, more targeting copper in your mix.
Brilliant. Wherever electricity goes, copper goes naturally, and we only have a finite amount. We're slowly but surely running out, and seems that BHP is on the forefront of it, which is brilliant. Now, I wanted to switch to another key topic here, which is to do with the banks. As we know, the RBA has done another cut in couple days ago, which if you ask any economist, they will say if there's another one, it's the flip of a coin.
Yeah.
No one really knows these days. But how are interest rates impacting net interest margins of the banks at the moment?
Yeah, it's an interesting game here. The whole idea that we need a rate cut is a fallacy, simply because you got all-time high asset prices, historically all-time low unemployment. Yeah, it's come up a bit, but the long-term average is around 5%, right? So unemployment has to go a fair bit to become normalized. Interest rates over long periods is about 4 to 5%. The fact that we are below 4% is ridiculous at all-time high asset prices. We have a property bubble. We live on a property bubble. We have 95% of our property loans are variable. So we are very sensitive. RBA should not be pre-cutting for problems, right? Because they don't pre-hike for problems, but they seem to. So the problem here is we're trying to have a central bank that's going to never have an economic down cycle, which is wrong, right? So which creates asset allocation problems. And so expectations are interest rates are going to go very low, right? Unless we're having a pandemic, and nobody's forecasting that, I don't see a huge play. So RBA is stuck between a rock and an asset bubble. So in that context, they're stuck. I don't think they're going to be doing too many cuts, but they will do one every so often because they're being pressured to. Banks will struggle because banks get 30 to 40% of their funding out of bond market, and bond yields did not move. RBA has cut rates 3 times, right? If you look at the bond yields, yeah, it's gone up and down, but generally it's just gone sideways. So the 10-year bond yield right now is higher than the cash rate. So their funding costs are still high. So the margins will get squeezed. And banks, people don't realize banks are cyclical. So as economic downswing, yields go down, their margins get squeezed, dividends go down, right? And that's just the normal cycle. So, but no one's going to care. Retail investors bought banks very cheap.
Yes.
So no one's ever going to sell because of tax implication, right? So they will sit there and watch it go up, watch it go down. CBA could be $500, no one cares. CBA could be $50, no one cares. No one's going to sell. But it is a matter of managing your portfolio. So right now, yes, is CBA expensive? Yeah, everyone knows CBA is expensive. Should you be selling some of it, take the tax hit, and allocate somewhere else? You should. But most people won't. But I get that, and it's completely understandable. But the reality is the banks are expensive. We're probably top of the bank cycle. And yields right now, you can get a better yield from the government on a bond than you do at CBA. Then why are you invested in CBA?
Exactly.
And that's the problem.
Another thing to quickly add is that if you look at the yield for something like CBA, for example, getting about, on today's prices, 2.5%, not even 3%. Even if you open up a CBA savings account, you get a better yield.
Yeah.
But look, I wanted to touch on one thing. What are our thoughts about credit quality and, I guess, bad debt risks?
Yeah.
Are we starting to see some cracks?
I think so. If you look at in the US, you can start to see delinquencies rising in all parts of the economy. That's no different to anywhere else. And they have fixed rates and they've got those issues. So I suspect we're just playing the game, and RBA is cutting rates to not alarm the market, to hide those debt problems. Most of the banks have reduced their bad debt provisions over time, which is kind of crazy, right? You've got all-time high prices, so everyone's borrowing even more, and you're boosting your profit number by reducing your bad debt provision. So when the bad debt provision, the bad debts come through, you don't have the provisions. And so the banks, when the bad debts start to come through, they will have dramatic increase in bad debt provision, which will create massive downgrade cycle. And that's the risk in that. It's kind of like, yeah, it's good till it's not good. And that's the problem in the cycle.
Exactly. And when it comes to the bank's dividends, because I know most investors watching, as you said, most likely hold the banks for a long time. Are there any potential upside surprises in this season? What are we expecting?
If the banks are starting to give better than expected dividends or special dividends or something like that, you have to worry because it is not for the long-term strategy of the banks, because the banks have given up trying to grow overseas or really do much more than basically come back to local mortgage play. So all they're doing is playing to the shareholders, and I get that. Management's got to do what management's got to do, right? They get paid in options and shares, and if the share price goes up, they all make money. No one complains. It's only when it starts to go the other way, then everyone starts to complain. So I think at this point, the dividends will be okay. We're doing, the cash is going good. There's no growth, but your dividends are going to be good. Again, it just comes down to people's willingness to sell. Because of tax, that's probably very low.
Yeah, exactly right. And look, moving from the banks, there's another key area that I'm sure many have their eyes glued on at the moment, and that's to do with the oil, gas, and energy type space. It's quite a hot topic. So what's the big picture on, say, global oil supply and demand at the moment?
Yeah, this is, again, was the only sector that was in value, and we're big fans of it. We like all segments. We like coal, we like uranium, we like LNG, we like oil. We are in Karoon for the oil play. We're in Woodside for the LNG play. We're in Paladin for the uranium play. New Hope for the coal play. Because at the end of the day, there are certain things, food, energy, everyone needs. And not everyone can get access to. So people tend to, when prices are down, supply reduces, and then demand doesn't really go away. And then that squeezes, and if there's any supply side shock, they pop. And that's what's happened. China has shut down numerous coal mines because they just wasn't making money, and so then coal prices bounce, right? And so similarly, there are demand pickup, or there's some kind of Middle East unsettlement, and then suddenly their supply is at risk, oil price goes up. And that generally has played out in all parts of it. So, you got Ukraine war that's running into LNG risk. So all of that is playing. We're very positive on the energy sector. It's not for the faint-hearted. Especially uranium. You can move up and down. You can play a number of these sectors through ETFs as well. So they're less. If you look at the uranium ETF, it's at all-time high. It's run 30-40% in the last 6 months. And so you can see those kind of moves. So you can play through, or you can go to specific stocks.
I'm sure most have seen recently what's happened with companies like Boss Energy.
Yes.
Wanting that type of volatility in a way.
And that's the part of the, I guess, in a resource sector. You've got operational issues, you've got management issues. It's not for the faint-hearted.
Of course.
But welcome to investing.
Yeah, exactly right. And look, one thing that's particularly interesting in the Australian producer type space, as you briefly touched on, is the LNG market. Where do you see the best opportunities?
Yeah, look, this is going to be interesting because it generally, globally speaking, LNG has been kind of like the transition option for green energy. We have seen a slowdown in transition towards green energy. So LNG will remain a substantial part of the offering for years to come, if not decades. So in that context, we are looking at it. We even look at the concept that we have a lot of gas on the west in Australia, not enough in the east. You need it on the east, it's got to come across the pipe. And we are actually long APA because they've got the pipe that it runs across. And so it is a natural progression. So we like those kind of things. The thematic is still going to be there. I think LNG will be part of the demand for energy for years to come. I don't think that's going to go away. There's not a huge amount of, yes, there's people find things, but they still have to drill it, get it there, infrastructure. Those things take time. And so the easy ones, everyone's done. In all commodities, it's just getting harder. It's just like copper. All the open pits, large-scale open pits are done. Now all the new mines are a lot more expensive, which means commodity price has to be higher to make it worthwhile.
Yes, exactly right. And looking at these types of, I guess, this sort of imbalance where in the energy space, especially in coal, for example, we're seeing a shrinking demand, shrinking supply, and there could be the potential for some price shocks like we saw back in 2022, where cold winters in China, naturally, we will have to go back to basics,
Yeah.
and coal being that backup. Same with oil, for example.
Yeah, coal, there's no new supply coming.
Yep.
There's zero supply coming. So any kind of shock, demand just squeezes the less supply and suddenly you pop up in price, and which is what's happening right now in thermal coal.
Exactly right. And for income-focused investors, which dividend-paying stocks really stand out to you in this context? So New Hope, We have Santos, Woodside.
Yeah. We look at different thematics, and as with anything, you want to diversify. So we like APA. It's got the pipes, and it pays you a very good yield, and it's quite defensive, and it's defensive in your portfolio as well. We see similar feature with Woodside. I prefer Woodside over Santos, and it's got infrastructure as well, and it pays a decent yield. So that kind of plays into it. And then you look at New Hope. Again, it's just a cash machine, right? It's selling. It's probably one of the simplest mine. It just sells out. There's no new supply coming, and just makes cash and pays you a good yield. Then you can look at, we like other thematics we'll talk about later, like food, and you look at rural funds. It offers that kind of, and then you look at things like Telstra, defensive, staple, like Woolies, Telstra. They're not cheap. Telstra, we've been there. I think it's nearly doubled. And in case it pays a very good yield. And it's defensive, and you and I know you're holding an iPad or you're holding an iPhone, you're connected to a telecom services. And Telstra is the biggest one around.
I believe Telstra is the one that I'm using today.
There you go.
Good. Well, look, moving from the energy side of things, I believe that a lot of people watching have a lot of questions about healthcare. So there's been a lot of drama going on in the States with these tariffs. There's regulatory pressures coming from the US, especially around drug pricing as well, where Trump has said he's going to reduce it by over 1,000%. I don't know how that's possible if he's paying them, but how much of a risk do you see given this situation for pharmaceutical healthcare type companies? For example, CSL, Sonic Healthcare.
Yeah, I mean, they're our preferred ones. I like them for different reasons. Think of, yes, regulatory risk is high, but there's a price for risk return, right? CSL, every couple of years, gives you a decent pullback, right? When it comes down to around the 240 level, you buy it. And it's exactly what we did, right? It's bounced to 260, 270. I think it goes higher. It's got a massive pipeline. So basically, think of it this way. It's running multiple ponies. If one of them takes off, you make a truckload of money. And it is probably one of the best growth stocks in our market, and consistently for decades, and I think it still does well. Now, it's volatile, so you pick and choose. Sonic is a bit different in the context that it's more Europe, so it's less of an issue. It's not coming up with a drug per se, it's more testing. So as you get older and, once you get to a certain age, you do a lot of tests, I should know. And when you do start doing these tests, you realize all of these tests are done through Sonic. So they buy these operations in Europe, and every man and his dog around the world, they have distribution networks. They collect, we do these tests, send it to them, they do it, send it back to you, they clip the ticket. It's a great business model. It got really cheap. It's just starting to recover, Sonic, because it was cycling out COVID time testing when it went berserk, right? So that, I don't think you're going to get to that. Let's hope not, because we don't want another pandemic. But because of the demographic change, as the world gets older, we're going to be doing more and more tests. Sonic benefits from it. It's in Europe, doesn't have the risk of the American tariff attacks, and everyone needs to do tests. So it's a service. So Americans, interestingly, only tariff goods because they don't want to tax their techs. So they tariff the goods, not the services. So what Sonic offers is a service. So it doesn't have a tax issue. So it's a great healthcare play without the government risk.
Of course, good. And I guess, look, moving on the side a little bit, of course, a weaker Aussie dollar could be a nice tailwind for offshore owners too. How meaningful could that be for investors?
Oh, huge. That's why in Australia, healthcare is the only sector that consistently outperforms the American counterpart because of the currency side of things. We do have great healthcare stocks. You've got your ResMeds, your Cochlears, your CSLs, but also because of the currency play, it benefits from it. So that's why you always have healthcare stocks in your portfolio. And if you don't have any, you should be looking at CSL and Sonic. They got structural upside and they have currency kicker.
Good. And I'm going to ask you a bit of a loaded question. It's almost like choosing between your two favorite children. Between CSL and Sonic Healthcare, what do you think offers the best risk to reward right now, especially coming into this reporting season?
Yeah, I think your upside is more in Sonic and it pays a better yield. Long-term prospects are probably better, where CSL, you can see it quickly running to 300, 320, right? But that's probably another peak and it'll come down again. So we are in one of those places where if you're, depending on what you want for your portfolio, I'm a big fan of Sonic. I think I prefer Sonic. There's more upside to it. I can see Sonic running 50%. Wow. So that's the upside.
Good. Wow. Okay, good. And look, I wanted to touch on the final area. And this area we briefly mentioned beforehand, and that's to do with food and agriculture. Agriculture doesn't always get the spotlight that it should. What's the state of global supply right now, Mathan, especially with geopolitics and weather events, natural disasters, and that whole jazz?
Yeah, the food sector is like your ugly child. You know, nobody wants to talk about it, but it gets you good returns. The reality is the fund managers generally stay away from it because of the volatility. But the cycle does go through. Weather has a huge impact and it's been quite erratic. You know, we've seen food prices. Food prices have come off from the, you know, post-pandemic peak, but they're still 30% higher than what it was pre-pandemic. So most of them are doing really well. Regional Australia is doing really well on the back of that. Farmers are doing really well. We do have drought in Victoria and South Australia. At some point, that'll get, you know, you'll get rain there and then there'll be a catch-up phase for them. So overall, Australian farmers should be doing well. Trade wars with US around the world, and US does have, how do I put this nicely, standards issue. So Aussie food is obviously premium and people are willing to pay up. Now, and I was in Japan last month and Japanese love our beef and our food groups, and their main problem is rice. They got massive rice shortfall. Majority of the inflation is driven by rice. I love my rice, and let me tell you, I am paying about 100% more than what I used to pay for rice in pre-pandemic. So there is definite inflation in food. Beef prices going through the roof globally, and locally in the last 6 months, that's starting to happen here. Beef prices are running. So if you love your beef, go get it now because prices are going higher at supermarkets.
Yes.
So that's, you know, fish, beef, all of these are going up, right? And so in that context, agricultural side of things should be part of it. So you can look at farming side, you can look at regional retail side, you can look at fertilizer, chemical side, all of that plays a part in the process. So we like number of stocks. We love Elders. They've made a big acquisition in Davids. Once that gets approved, that'll make them a huge player in the regional Australia. And that's had a bit of a run, and I suspect that'll keep going. And it doesn't report with the rest, so you don't have the reporting season risk as well. The other one is Dyno Nobel, which used to be Incitec Pivot, fertilizer and explosives. You look at Orica share price, it's pure explosive. It's gone through the roof. So both parts of the business are doing well. And if there's any issues with Russia, which are dominant fertilizer supplier, fertilizer prices are going to go through the roof. So Dyno Nobel is another one worthwhile keeping an eye on. And there's a number of other food players that we look at, but at the moment we're sticking to the big guys. And as the market interest returns, we'll go in. And at the moment, both of them, Dyno Nobel and Elders, are doing really well.
Yes, yes. Dyno Nobel being a very, very interesting one from splitting off and changing from Incitec. And I guess you mentioned a very interesting point very briefly about beef prices. So it has been a leading factor in food inflation. Look, is that a trend that you believe is set to continue?
Yeah, look, if you think about it in the Australian climate, we've got Victoria and South Australia in drought.
Yes.
So generally when they're going to drought, farmers are going to get rid of their cattle. And once they get the rain and things start to improve, then they have to rebuild their herd, which means they'll go and buy in the market. And it's likely to remain elevated for a good year or two as the rains come and they rebuild their herd. Now, also you got, you know, America might be telling everyone to buy American beef, but most people don't want to touch American beef.
Yes.
But everyone wants Australian beef. So that keeps us in the market. When you got all-time high prices, right, and prices going higher, that's going to bring in more and more demand for our higher quality beef. Yes. So I suspect the whole food thematic is undervalued and the market doesn't pay, just like energy. Energy is now one of the better performing sectors in the last 3 to 6 months.
Yes.
I suspect similarly food is being ignored. It'll come back in style. And that's the whole idea of investing. You're trying to go into sectors where the thematic is there, the market is not looking at it, so that when the market gets interested, you get the real run from it.
Brilliant. And I guess for investors wanting that type of exposure, Mathan, which leading ASX listed names come to mind right away? What should we be putting on our watch list right now?
Look, you naturally you look at things like Elders, Grain Corp, Ridley, which is cattle feed and so forth, and then you got Dyno Nobel. So that kind of covers all the main categories that we're in.
Good, brilliant. And I guess to close things up there, if you had to give investors one or two key takeaways for this reporting season, that is, what would they be?
Look, I think we're near all-time high. Our markets are a higher multiple than when rates were zero, right? So obviously there will be some reality check that'll come through. The economy can't keep going where it is. So this is a good time for you to look through your portfolio and balance it out a bit more, diversify your portfolio, manage your risk. That's the key thing. I think some people have done well by pure chance. And some people you've had bank exposures. You don't want to sell, it's gone up. It gives you a great opportunity to, you might not, I'm not saying go out and sell everything you got, but sell some of it, buy something else to protect your portfolio. Diversification, like we've looked at a lot of sectors like healthcare, energy, food, these kind of things that benefit and they're not as expensive. You can sell some of the other things and buy something else to diversify your portfolio. So if the cycle does go against you, you're not going to go down as much. So risk management is going to be the key thing.
Brilliant. Look, fantastic insights as always, and thank you for joining us, Mathan. Look, thank you everyone for watching as well. We'll see you next time.